Hey there, I'm Veronica Irwin, a reporter at Unchained, and I am here with Caitlin Long, who is the founder and CEO at Custodia Bank. Custodia Bank describes itself as a software platform with a bank charter that is built to connect digital assets to the traditional finance space. So, Caitlin is really at the forefront of discussions about crypto and banking. So, Caitlin, welcome.
Thanks, Veronica. Good to be with you.
Yeah. So, like I said, I thought you would be the perfect person to talk to about what crypto Twitter or crypto X has been really in a tizzy about for the last week or so, which is what Nick Carter, a crypto investor and general partner at Castle Island Ventures, calls Operation Choke Point 2.0. So, just to start, what is Operation Choke Point 2.0?
It is the federal banking agencies locking arms to pressure banks to stop banking lawful industries. 1.0 was started during the Obama administration. It started with the payday lenders, with the FDIC pressuring the banks behind the scenes, and ended up spreading to 30 different industries. It was stopped under the Trump administration, but the same person is in charge of the FDIC, Marty Gruenberg, and he brought it back against the crypto industry and more recently against financial technology companies too.
And you feel that you've been kind of a target of this yourself in a way, right?
Oh, we know we have. There's evidence of it. Yes.
Yeah. So what what I understand really got Twitter or X upset last week was when Nick Carter posted excerpts of a filing from the Silvergate bankruptcy. Um, and he was basically saying it's this declaration from Chief Administrative Officer Elaine Hetrick. And he was saying that it substantiated a lot of his own reporting on Pirates Wires about Operation Choke Point 2.0. But can you kind of explain what was so important about this filing that Nick kind of highlighted?
Yes, and I'll give credit also to American Banker. Kyle Campbell at American Banker published a story at about the same time. I'm honestly not sure which one was first, but the banking world doesn't talk to each other on Twitter. I will tell you, though, they are also all a dit and Twitter about this because they're seeing federal banking regulators suiciding banks for reasons that were not published under the Administrative Procedure Act and don't exist in any rules anywhere. And this is the kind of thing that the bank regulators have been living with for a long time. And so the issue is that the bank regulators, because so much of bank regulation happens behind closed doors, and that was designed to protect the banks against bank runs when there were issues. The whole idea was let's keep that all behind closed doors so the banks could work those issues out. What has happened is that the federal bank regulators, I've not seen the states do this. State bank regulators have not done this to my knowledge, but the federal bank regulators, the FDIC, and in this case, the Fed, clearly put pressure on Silvergate to essentially diversify its business, which was an impossible task in a short period of time, or fold. And that's what came out. That's the news that came out. To my knowledge, there are no other examples of an industry that's been targeted like that for diversification, where a bank that is specializing in an industry like that is told by bank regulators, you have a very short period of time to diversify your customer base, which was almost 100% in the crypto industry. To get it down to 15% in a very short period of time would have been impossible. And that's what Elaine's affidavit described. It was impossible. They used financial advisors to look at whether they might succeed at that, whether they might be able to sell the bank under the huge regulatory cloud. And they ultimately decided to just liquidate. Nobody except the shareholders of the company lost money, and including and especially the FDIC insurance fund.
Mm-hmm. Yeah, the filing was really surprising in that we just have not had anybody on record from Silvergate. And here is Elaine saying it under penalty of perjury that they faced intense regulatory pressure and that they managed the bank run, that they were able to provide money to anybody who was pulling money out of their accounts, that they were still liquid, that they were still solvent. Because you mentioned the APA, I'm wondering if you can just explain for anybody who doesn't know what that is and like how it's supposed to work.
Well, the whole idea is that federal regulators are supposed to publish their rules, and the Administrative Procedure Act requires rules that have significant impact to be put out for public comment. There's something called an ANPR, Advance Notice of Proposed Rulemaking, where the agency puts it out for public comment. There's a public comment period. The agency has to consider the public comments, and then they publish it in the Federal Register. The other place where rules can appear in the banking industry at the federal level is something called the FFIEC examination manual. This is what all the bank regulators in the United States, both federal and state, use to examine banks. And there are rules that go in there, but in either case, there's a public notice of these rules. And what's so unusual about this is that the respect for the rule of law seriously went out the window here, it appears, with this arbitrary and capricious, that's a very specific term under federal law, this arbitrary and capricious application of this 15% rule to a lawful industry. I've never seen or heard anything like that applied to the banking industry in the past. And I've talked to banking historians and experts, and they've shared with me the same is true. They can't think of another situation where there was this arbitrary rule that was designed to target banks specializing in a specific industry and was used to, and it was weaponized against those banks.
Mm-hmm. And something that stood out to me is in this thread, or in response to this thread from Nick Carter, multiple people pointed out that there was a specific percentage that the Fed and other federal regulators, but mainly the Fed, was imposing a 15% cap on crypto deposits. Austin Campbell is who came to mind as like probably having the most seen liked retweeted response to Nick Carter saying that.
Yeah.
And if that were the case, like what is so significant about that specific percentage cap?
I have no idea how the regulators came up with it. This is one of
Yeah.
the reasons why when arbitrary rules like that get created, you have to put it out for public notice and comment. And Austin made a really good point that that revelation confirmed his worst fears, that the federal bank regulators don't understand risk. And I think he's right. He said they were applying a 1970s approach to risk management to a 2020s problem. And specifically, what the federal regulators, I think, are trying to do here is to say, you've got to diversify away from high risk customers and have a diversified customer base. Now, Austin is saying, no, that's exactly wrong. This is about interest rate risk. Yes, we've always known. Frankly, I was warning the Fed about Silvergate and Signature being at risk of bank runs before the bank runs happened, because if you looked at their balance sheet, it was pretty clear. They had 10 cents in cash against demand deposits that could be withdrawn in the span of minutes. So unless you were within the first 10% to withdraw, then you had the risk of not being paid out. What turned out in Silvergate's case is that they were still able to manage it because they had enough excess capital. And that was news to me. And that we now know under Elaine's court filing, under penalty of perjury, they survived the bank run and they were able to service their customers. It was the federal regulators who shut them down. But back to Austin's point, who forced them to shut down by putting them into an impossible choice, a Sophie's choice, so to speak. But back to Austin's point, the way to handle that risk management, if you've got high risk customers, then hold 100% of the deposits in cash instead of 10 cents of the deposits in cash. Don't take any interest rate risk. Don't take any credit risk. Don't engage in maturity transformation or lending activities. Just hold all the customer deposits in cash. And guess whose business model is exactly that? Custodia and the Wyoming Speedy Banks.
Right, right. I guess, yeah, circling back to just Operation Choke Point One, that really became confirmed, I suppose, when the Wall Street Journal unearthed hundreds of pages of filings, or
Yes.
not filings, but memos and communications between government agencies. Yet to
Yes.
be seen if we will ever get something like that for Operation Choke Point 2.0. But I think looking forward, hopefully we get further confirmation of some of this information. Obviously, we are hearing it from lots of people in crypto and banking. And hopefully we get that final confirmation. But looking forward, is there anything that you're anticipating, I guess, on this story?
There's actually plenty of confirmation out there already from the Custodia lawsuit, because even though we didn't sue specifically over Operation Choke Point 2.0, like the payday lenders did under Operation Choke Point 1.0, and
Mhm.
that's where a lot of that discovery was revealed. The
Mhm.
FDIC was lying. They said they were not doing this. And then when the discovery came out and all this proof came out that they were actually doing this, the FDIC settled and said we wouldn't do it again. Well, guess what? They're violating that settlement. It's just that they're violating it against a different industry now. And so the industry would have to sue. But what's interesting is our lawsuit is peripheral to that at Custodia. We're suing over a different issue. But a lot of the discovery that came out that is public in the Custodia lawsuit reveals a very clear timeline, which is that the Fed was actively working with the state of Wyoming, was eager to roll up sleeves, figure out how to safely integrate digital assets into the banking system. And then FTX happened, and there was a meeting right before Thanksgiving 2022 with Michael Barr to discuss Custodia's applications. And then the first draft of the Custodia denial memo appeared right after Thanksgiving, the next business day. So it's very clear, putting those puzzle pieces together, who made the decision to deny Custodia, and it was 2 weeks after FTX. And then you see the wheels in motion. And again, I'm pointing all of this to publicly available information that not only the approach of the Fed towards Custodia went 180 degrees from positive to negative, but also the approach of the Fed to digital assets went from 180 degrees from positive, or at least open, to viciously negative. And it's also interesting because we talked earlier about confidential supervisory information, that very little of this kind of information comes out about bank regulation, which is unfortunately something that allowed the federal bank regulators to weaponize their power against the crypto industry and hide behind confidential supervisory information, which is criminal to reveal. But here's the funny thing. The Fed, in its denial memo of Custodia, published it 86 pages. We had a career Fed person advising us at the time. She said, I've never seen anything like this, never seen anything like the amount of confidential supervisory information that the Fed has ever publicly published about any applicant. We were clearly targeted for unusual treatment. And here's the punchline. The longest ever Fed denial before the 86-page Custodia denial in Fed history was 3 pages. So clearly the Fed was targeting us, targeting the crypto industry, and revealed a lot of confidential supervisory information, which is part of the reason I can talk about it, because so much was public. And they did that clearly on purpose, clearly, as we say in Wyoming, a strategy of shoot the stallion to scatter the herd, trying to send a message to everybody. Don't try to do what Custodia did. We're gonna skewer you. But the funny thing is, they tried to intimidate Custodia with those bullying tactics, and we stood firm. And the way to handle a bully is to smack them in the nose. And we're still in litigation with them 18 months later. But back to your original question, an awful lot of evidence did come out, and I think folks should probably go to the publicly disclosed documentation in the Custodia case, because you will find lots of evidence of this U-turn that the Fed had towards digital assets. We were not wrong in believing that we were going to be approved by the Fed. There was a lot of evidence that it was in process. We had it in writing that they were going to give us. We didn't make it on the first exam, but we had it in writing that they were going to give us a second exam. And then FTX hit, and then they yanked that promise. So that's all public. You can figure all that out for yourself, and there's plenty, frankly, to underscore that something untoward happened, not just towards Custodia, but more broadly to the digital asset industry, for sure.
Right, right. Well, I think that's a good place to end it. Thank you so much for chatting with me today. I appreciate it.
Thank you. Nice to see you.